Borrowers and lenders both care about the real rate of interest. If they somehow knew for sure that the rate of inflation would increase by, say, 1%, lenders would require an extra 1% increase in the nominal interest rate they were willing to take in order to be willing to lend. And borrowers would understand that the value of the dollars they paid back had fallen by 1%, and they would be willing to pay an additional 1% in the nominal rate of interest and borrow the same amount and undertake the same projects. Of course, Fisher's hypothesis cannot be literally true, because there are never events that lead every decision maker to agree on their predictions about the future course of inflation. There's disagreement. But there are events that occur which lead to widespread, if not perfect, agreement on the future course of inflation. When such events occur, all interest rates should move together. If the future path of inflation is expected to be lower, all interest rates should fall. If the future path of inflation is expected to be higher, all interest rates should rise. Let's put this to the test with some data. The graph plots the 10-year Treasury bond rate. It's in blue. And the Consumer Price Index inflation rate. It's in red between 1954 and 2010. Okay? But it plots something else as well. The chart suggests that Fisher is correct, that changes in inflation trends cause changes in the interest rate. So let me explain. In blue, I have also plotted the trend line followed by the nominal rate of interest shown in blue. It's that very smooth curve. And I have also plotted the trend line followed by the rate of inflation. It's the very smooth line pictured in red. The trend lines, both the blue one and the red one, provide crude estimates of the expected path of each series. Presumably, borrowers and lenders might not always have foreseen the wiggles in the inflation path, but it's reasonable to believe that they would have detected and therefore foreseen the trend line in the red smooth line. That means as interest rates were rising and as inflation rates were rising, they would have been able to predict the trend in the future. And as inflation rates came down, they could predict that that trend was trending downward. What I want you to notice, and this is very, very important, is that the two trend lines are very nearly parallel lines. What's that mean? Well, it means that as inflation expectations, as modeled by the red trend line, rose between 1955 and 1980, the 10-year Treasury bond yield rose to build in compensation for that inflation. As inflation expectations fell after the initiation of the Volcker regime in the Federal Reserve in 1979, the red trend line began to fall and the 10-year Treasury bond rate fell as well. Okay, solid evidence in favor of Irving Fisher, but there is another way to check the validity of Fisher's hypothesis, and that is by comparing the yields on inflation-protected bonds to the yields of similar bonds that do not offer inflation protection. We've already seen the TIPS, TIPS, are inflation-protected Treasury bonds, and we discussed these in a previous lecture. TIPS provide protection against inflation. How? The principle of a TIPS increases with inflation and decreases with deflation when that inflation and deflation are measured by the Consumer Price Index. When a TIPS bond matures, the owner of that bond is paid an adjusted principal or the original principal, whichever is greater. And the adjusted principal is adjusted upward for changes in the Consumer Price Index. I'm now going to show you another chart that depicts the yields on a 20-year constant maturity Treasury bond with inflation protection and without it. So what do we learn by looking at the chart? We see that the non-inflation protected bond has a yield depicted in blue that for the first 2/3 of the period hovered right around 5%. It dropped then and recovered in the last quarter of the period to roughly its initial level. We see that the yield on the TIPS, the inflation-protected bond, hovered slightly above 2%, spiked upwards in 2008, and then gradually began to fall. But what I really would like you to pay attention to here, what I really think is important, is that for most of the period, the difference between the inflation and non-inflation bond yields was trapped in a tight band between 2 and 3%. On average, a non-protected bond paid about 2.5% more than a TIPS bond, indicating that the market valued the inflation protection the TIP provided, but also indicating that the additional interest rate that non-protected bonds had to provide did not change very much. With one exceptional episode, the difference between non-TIP and TIP yields varied less than the yields themselves. The onset of the financial market crisis in 2008 had a very interesting impact on bond prices. It raised the price and lowered the yield on standard bonds and lowered the price and raised the yield on TIPS. That result was an unusual fall in the premium paid by non-TIPS bonds relative to TIPS bonds. Some analysts attribute this decrease to the Lehman Brothers' attempt to sell off large quantities of TIPS just before they failed as a result of a financial crisis. Others suggest that the result is due to fears of deflation, which were voiced in the latter months of 2008. Well, if those fears are what's causing that phenomenon, if deflation occurs, for example, TIPS should have the same yield as non-TIPS Treasury securities of the same maturity, because the TIPS contract does not specify a reduction in the principal in the case of deflation. Remember, it pays the minimum of the inflation adjusted and the actual face value. So, one way to look at the data is that concern about deflation caused the rate on TIPS and non-TIPS securities to converge for a short period of time. The bottom line is that we have another piece of data that suggests that concerns about inflation tend to raise interest rates, and because those inflation premia are approximately constant, except in extraordinary circumstances, raise them up and down together. Higher inflation, higher interest rates. Lower inflation, lower interest rates. A second reason that interest